When did you guys start seeing I don't know if the writing on the wall is the right word, or just starting to see the market really change? We kind of know when we started feeling it as investment brokers, but as debt specialists, when did this all start kind of taking shape? Was it really, when the Fed started moving those rates upwards a couple years back?
Yeah, I would say, middle of last year is when we really started to see it affect a lot of deals in the pipeline. And then also a lot earlier in this year because we had some quick, back-to-back rate hikes
Right.
that were fairly substantial. And so we did have deals that fell out because underwriting standards had changed at the bank level or at the credit union level. So the lenders were having to increase rates mid-processing, mid-loan committee. And that put a wrench in those deals.
Sure.
And so we've been seeing that throughout the year. With that said, deals have still been getting done, but it's very situational. It's what's motivating that borrower. Is there something motivating that lender? And so you have to get into the story of that deal to understand, is this something that's going to make today or something that could wait because of rates?
Give us a baseline. I know this is a big blanket statement. There's about 13 different asterisks you could put by it, but give us a sense of where we were with rates, LTVs, DSCRs, debt yields if you need to, but just the general metrics that what lender would look at 2 years ago, 3 years ago, before this market started really becoming a force and a change. Where were we in terms of those markets, and where are we now?
I mean, I'd say 2 years ago, 70 to 75% leverage across the various types of lenders for
Right.
self-storage.
Which would be
CMBS lenders, life insurance companies, banks, credit unions. You
Right.
could get max leverage with just about everybody because the cost of capital at that time was so low relative to cap rates. The math just worked. Now you're seeing, really, hopefully 50 to 60% leverage, sometimes 65 if there's a little bit of room in the business plan to allow for an increase in revenue, top line. And so some lenders are willing to inch up or maybe have some kind of future funding tied to performance metrics. But I'd say DSCRs have stayed relatively the same. It's just that equation has the cost of capital figured into it. So as that's moved, unfortunately, it's moved what that number really means, although the metric or the ratio has stayed the same, if
Right.
that makes sense.
right.
And 2.5, 3 years ago, it wasn't uncommon to get a construction loan. Like I procured one for a client who was developing storage in Arizona. We had a floating rate construction loan at 3.5. And that's floated up since because it
Right.
was floating rate, and it's now near 9.
Right.
And he's looking to refinance as a result.
That 6 to 7 to 8 year period in the past, that's more of the anomaly
Yes.
than it is the norm, right?
I mean, I was sitting in a multifamily conference yesterday where there were several gentlemen who had been in the business for 30 years saying 7, 8, 9% the deal. They've always underwritten to those metrics, and the last several years they just haven't gotten deals done because they said the deals didn't underwrite. But they said that's what they felt like kind of normalized interest
Right.
rates would be or should be. And so now they're starting to get back into the game, but that's a certain level of discipline for a certain type of borrower.